Good afternoon, everyone, and thank you for joining us. I'm Benjamin. I'm Head of Intelligence at UK trade body, the Payments Association. And my role today is to moderate this webinar called The Invoice Payment Gap, How UK Businesses Can Collect Faster in 2026 and help connect the dots between what the data is telling us and what businesses can practically do about it. Now, today's webinar is focused on what we're calling the invoice payment gap, right? That persistent lag between issuing an invoice on 30-day terms and actually getting paid 60, 90, sometimes even 120 days later. Now, it's a problem that affects cash flow, growth, and frankly, a lot of finance teams' sanity. And it's worth saying up front that this isn't just a receivables problem. Delays often sit across both sides of the transaction, from accounts payable bottlenecks and approval workflows on the buyer side through to fragmented systems and manual processes on the supplier side. Now, we'll be exploring why that gap exists, why it looks different for SMBs and mid-corporates, and how modern payment approaches, including a pay-by-bank, are starting to close it. And we'll also touch on the regulatory backdrop heading into 2026 and what that means in practice. So let's quickly ask our panelists to introduce themselves. Raj, should we start with you?
Yeah, thanks, Ben. Hi, I'm Raj, and I'm Senior Business Development Manager here at Access PaySuite. This is my fourth month in the business, and prior to this, I was Head of Business Development for a company called Aldo, looking after sort of sales for the open banking propositions. And pretty much most of my working life has been involved in the payment sector, essentially working closely with businesses to solve some of those complex challenges around making and receiving payments, and essentially helping those businesses circumvent some of those challenges. So that's what I've been doing.
Great, thanks, Raj. Alex?
Hi, I'm Alex, Head of Commercial for the UK and Ireland at Tink, a Visa open banking company. I've been at Tink for about 3 years now, but I've been in payments my whole career, spanning about 11 years at various card acquirers. But in my role, I lead all commercial activity across the region and focusing on accelerating, account-to-account payments, particularly focused on building and scaling strategic partner channels, most notably with partners such as Access Group, to drive adoption of open banking payments, aka pay by bank.
Great, thanks, Raj. Thanks, Alex. Well, obviously we have a lot to cover today, so let's jump in. I would like to start first by focusing on where the invoice to payment breakdown happens. So, Raj, let me start with one of the headline findings from Access PaySuite's research. Now, 51% of finance leaders say their payment systems only somewhat meet their business needs. Now, when we talk about the invoice to payment gap, where does that breakdown actually occur? Is it invoicing itself, or what happens after the invoice is sent? And what are the main sources of friction that stop businesses getting paid on time?
Yeah, good question, Ben. I think the breakdown isn't at the invoice creation stage. I think it's what happens after it's actually sent out. Some of the common friction points that we're seeing are things like approval delays. So invoices sit in inboxes waiting for sign-off, often because approvers are away or overloaded with work. Lost or misrouted invoices is another problem as well. A single wrong email address can stall payments for several weeks. You then got things like customer confusion. So if payment instructions aren't clear, customers sometimes hesitate or make mistakes as well. And then, of course, issues around mismatching of invoices. So things like when payments arrive without correct references, finance teams then therefore have to spend hours reconciling manually. So I don't think the issue is about bad intent. I think it's about broken processes. Every delay adds to your DSO. Obviously strains business cash flow and forces finance teams into what they call firefighting mode instead of what they should be doing, which is strategic work.
Yeah, Raj, that's a useful distinction. And I guess what many of us are seeing time and time again is that late payment is less about unwillingness to pay and more about fragmented processes once an invoice leaves the system. And And that's really the theme, I suppose, for today's webinar, and how simplifying that journey can materially reduce delays and friction. Thanks for that. Let's move then to discuss payment friction, SMBs versus mid-corporates. Now, another striking finding, of course, is that finance teams are losing an average of 16 hours a month just resolving payment issues. Now, Alex, to you, from what you see across the market, how does payment friction differ between SMBs dealing with manual processes and mid-corporates managing more complex approval chains and systems?
Yeah, I think what we're seeing across the various businesses that we work with is that, the source of payment friction can look really different for, SMBs and mid corporates. And importantly, it affects, both the supplier and the payer in a B2B transaction journey. So, for SMBs, if we look at them first, I think the biggest issue is really a manual process overload. And what I mean by that is finance teams are having to jump between systems. So copying bank details into an online banking portal, checking payments manually, and then chasing when something doesn't match. And, it's very hands-on, loads of delays and errors are, almost inevitable in that kind of system. Mid corporates kind of have the opposite problem. They usually have more systems, but those systems don't really talk to each other. So you've got the ERP, you've got the invoicing platform, you've got the bank portal, reconciliation tool, and then maybe you've got 2 or 3 approval chains layered on top of those. So even a small delay in one of those kind of steps will cause a multi-week lag. So, that's the business side of things. And then there's the payer side, where in a B2B scenario, the customer typically receives the invoice and then has to manually enter the bank details, retype the reference, move through an approval flow, and then push the payment through a batch-based rail like BACS. And that journey, as we know, is clunky. So even willing payers, will tend to put it off. Or they'll send the payment, but the reference is wrong, which creates even more work for the supplier. So I think if you zoom out, SMBs will struggle because there's too much manual work. Mid-corporate struggle because there's too many disconnected systems, and then the payers struggle because the payment journey itself is full of friction. So the result is the same across the board, and as Raj has touched on, people end up firefighting instead of forecasting.
Yeah, I completely agree, Alex. And I suppose while the root causes differ, the outcome is the same, right? So for SMBs, there's often too many manual tasks, as you said, right? Copying details, checking spreadsheets, chasing, and for mid corporates, it's too many disconnected systems and approval layers, and right. And as you said, right, in both cases, finance teams, I suppose, end up firefighting instead of forecasting, sort of the big problem. Okay, so let's move now to focus on the practical steps to remove payment frictions. Now, to Raj, I'm wondering, once we accept that chasing invoices harder isn't the answer, what practical steps can finance teams take to actually remove friction from the payment process and close the gap between invoicing and actually getting paid?
Yeah, good question, Ben. So, there's a few things that they can do. So firstly, sort of making paying obvious. So essentially encouraging immediate settlements by including things like a clear pay now button on invoices will certainly help. Provide multiple payment options up front, and don't assume that customers know your preferred method. I think that's quite a common mistake that businesses can make. Then it's things like matching payments to the situation. So, recurring invoices, I think, direct debits is great because it provides that predictability. Then for some, your one-off invoices, obviously like, pay by bank or account to account payments is great for speed and security. And then, of course, things like, for your urgent payments or those ad hoc payments, having a stable card acceptance solution provides that added layer of convenience as well. And I think stop chasing blindly, automate reminders before invoices are overdue. That I think that will help. And then use dashboards to track pending payments instead of just, manual processes like spreadsheets. I think the less effort it takes to pay, the sooner you get paid. These steps turn payments from a chore, I think, into a simple click. And I think having such steps in place has huge benefits for the business in terms of improving the cash flow, reducing admin time, freeing up finance teams to focus more on of the strategic work, And for the end customer, I think paying, it takes the guesswork out of the equation and provides essential convenience when I'm making those payments as well.
Yeah, Raj, I mean, that's the key shift, isn't it? Right, making it easier to pay benefits both sides and turns payment from a manual cleanup exercise on something far more predictable. Now, I'd like to shift the conversation to open banking, it's account to account versus traditional invoicing and backs. Now, to Alex, one for you. Let's talk about account to account payments and pay by bank. So, how does that compare to traditional invoicing and backs, both for the business sending the invoice and for the customer paying it?
Yeah, I think it's a really good segue into, what we touched on just there about, making payments simpler. So I think the biggest shift with account to account payments or pay by bank is that it collapses that entire payment experience into a single and seamless flow. So if we compare it to something like backs or a manual bank transfer, the payer has to find the invoice, manually type in the bank details, enter the correct amount and the reference, and then go through those kind of internal approvals that we spoke about. And then they have to wait 2 or 3 days for that payment to settle. So there's lots of friction, lots of steps, and there's lots of opportunity for delay and error. So Pay by Bank removes those steps entirely. So the business sends an invoice with a single payment button that Raj talked about earlier. The customer clicks it, selects their bank, and authenticates through their bank and using biometrics or strong consumer authentication. All details are pre-filled and locked in, and then the settlement happens instantly through the faster payment rails. So there's no retyping, there's no errors, and there's no excuses really not to kind of make that payment. So then if you compare that to backs, which was designed in the 1960s for payroll, not modernized for business to business payments for today, because it takes up to 3 days to settle. There's no real time confirmation, and that batch based system it means that even if the payment's approved, you've got to wait until that next run or that next cycle. So for the businesses issuing that invoice, I think the benefits are really clear. You get no manual errors, instant confirmation, and critically, it removes those excuses for late payment that we talked about earlier.
Yeah, absolutely, Alex. And from a payments ecosystem perspective, this is about collapsing the journey, right? So fewer handoffs, fewer approval delays, fewer data breaks. And then when payment and data move together, you actually remove a lot of the friction that I guess AP and AR teams have historically had to work around. So really, really good answer. Thanks for that. Now, I do want to talk about reconciliation portals versus remittance processes. So one for you again, Alex. Now, obviously the Access Pay Suite's research shows that 41% of finance leaders struggle with reconciliation across systems. Now, how are businesses obviously tackling this today, Alex? And particularly when you compare to traditional remittance emails and PDFs with more modern invoice payment portals?
Yeah, I think reconciliation is actually one of the biggest pain points we probably hear about. And for me personally, I think it's one of the biggest areas where open banking is actually making a real tangible difference. And businesses are tackling it in 2 ways, both on the payment side of open banking, but also on the data side as well. So like first on the payment side, I think we've touched on it in this session that, the traditional, remittance payments, as you call them, are messy, customer emails, PDFs, as you mentioned, upload to spreadsheets and, or pay through their bank with missing or incorrect references. Now that forces, teams into a slow manual like matching to do that reconciliation. When Pay by Bank is embedded from a payments point of view, inside like an invoice portal, the payments and the data, they travel together. So the invoice ID, the customer ID, and the reference are all pre-filled. The payer can't change or mistype anything, and the settlement happens instantly. So finance teams can just get real-time confirmation. They don't have to wait around and chase a payment. So that means more payments are reconciled automatically without that manual intervention. So that's on the payment side. But on the data side of things, we're seeing a big shift in how like ERPs and accounting platforms are using open banking to improve that reconciliation. So platforms like a Xero, a Sage, a QuickBooks, they're all pulling in real-time bank data through open banking connections. So that gives these businesses up-to-date cash positions. It gives them automated matching between invoices and incoming payments, fewer timing mismatches because banks feeds usually update multiple times per day, and a single source of truth instead of your individual siloed systems. So that reconciliation improves not just because the payment is cleaner or clearer, but because the visibility into the bank account is real time. So for me, I think the trend is clear that businesses are moving away from that kind of reactive remittance emails and towards, proactive data-rich payment flows where both that payment and that bank data are powered by open banking and reconciliation essentially, takes care of itself.
Yeah, I totally agree. I mean, this really, I think, underlines the issue that payment and data have historically moved quite separately. And when those two finally to travel together, reconciliation stops being a manual problem and starts becoming automatic. So yeah, thanks for your insights there. I do want to talk about payment choice without actually operational chaos. Now, perhaps one for you, Raj. There's an interesting tension, obviously, in the data now. From PaySuite's research, 90% of consumers say that payment method is important, yet 44% of finance leaders cite the costs of managing multiple providers as a challenge. Now, in essence, I suppose customers value payment choice, but finance teams worry about the cost and complexity of managing multiple providers. Now, how do businesses offer flexibility without creating reconciliation chaos behind the scenes? Big question.
Yeah, good question again, Ben. So businesses fear that offering choice means more complexity, multiple providers, fragmented reporting, and all that additional extra admin that they have to deal with. But I think the smarter approach is a couple of things, creating a unified experience for customers, a single payment portal or link that offers multiple methods, I think is really important. I also think that one set of records for finance is also important. So all transactions should flow into the same reconciliation process, making it easier for those finance teams. And then behind the scenes, you can support things like direct debits, pay by bank, and card payments without exposing complexity to the actual customer. Ultimately, customers get the flexibility, and I think teams get simplicity, and choice doesn't have to mean chaos, I believe.
Yeah, I agree, Raj. We often talk about payments as a customer experience issue, but it's also in many ways a brand and trust issue, right? So payment experience is increasingly part of how a supplier is judged commercially and not just operationally. So yeah, really good insights there. So Raj, I want to stay with you because I also want to talk about payment options in RFPs and buying decisions. Now, I'm wondering, are payment options now part of buying decisions? Now, so with 41% of finance leaders saying meeting customer payment preferences is a challenge, are procurement teams and corporate buyers starting to expect more when it comes to how suppliers actually get paid?
Yeah, I think there's that expectation. I think it's there. I think it's quiet, but I think it is significant. I believe now the buyers expect a lot more when it comes to payments. So, ensuring that those suppliers provide easy digital ways to pay, I think is a kind of imperative in that process. Providing direct debits for those regular suppliers, and of course, minimal back and forth for the finance teams. These are some of the considerations I think that they're thinking of. And why does it matter? Well, I think suppliers who make payments simple and reduce friction in the procurement process will help. And payment experience is now part of supplier experience. Those who offer convenience, I think, stand out. I think being easy to pay isn't just good service anymore. It's a competitive advantage for the business. I think comprehensive payment functionality is now become an extension of the supplier's brand collateral and ultimately how the brand is perceived in the market, I believe.
Yeah, totally. And I think what's quite interesting here is that payment experience is moving beyond a hygiene factor, right? Now, see, for some buyers, it's becoming a genuine differentiator when choosing between otherwise similar suppliers. So yeah, really good insights there, Raj. Thank you. So it would be very remiss of me not to talk about late payment reforms and predictable cash flow. So I want to talk about that for you, Alex. So let's look ahead, right? So the 2026 of the payment reforms will increase pressure on larger buyers to pay SMB suppliers faster. Now, Alex, if we're considering defining that 45% of finance leaders struggle with predictable cash flow, how should smaller suppliers be positioning modern payment methods in those conversations?
Yeah, I think the timing of this is really interesting. I think the 2026 reforms will be a real turning point because they put reputational and regulatory pressure on larger businesses to pay on time. So for the smaller suppliers, this creates an opening in that conversation. You can position modern payments, your payment options, not as just convenience, but as actually a compliance and efficiency tool. So they help your customers meet their own late payment obligations. They reduce the administrative workload on both sides, and they create like an audit trail. So that supports the buyer's, reporting duty. So when you say, 45% of financial leaders say they're going to struggle with predicting cash flow, it becomes a shared problem, not just a supplier versus a buyer issue. So the narrative should be, modern payment options help both of us stay compliant, reduce workload, and improve predictability. And that reframes the conversation completely from please pay us faster to here's a way that we can both meet our regulatory and operational goals.
Yeah, Alex, and the reframing here is important, right? Because this isn't just about please pay us faster. It's about helping both sides, I think, meet their obligations, improve auditability, and create more predictable cash flows across the supply chain. So yeah, completely agree with you. I know we're burning out of time, but I do want to talk about implementation and timeline. So for Raj, one for you, when finance teams obviously hear the word implementation, often assume a big IT project. Now in practice, what does that actually look like with Access Pay Suite, and particularly for businesses already using tools like Xero or other accounting platforms?
Mm-hmm. So implementation is fast because Access Pay Suite offers multiple integration paths. We have an off-the-shelf Xero integration, and we're now a Zapier connected app as well. So customers can easily build workflows or connect through Zapier as an API aggregator. And for deeper projects, we provide a full open API for complete end-to-end implementation. This flexibility means businesses can get up and running in days instead of weeks, dramatically reducing integration costs. Whether they want simple plug-and-play, low-code automation through Zapier or full API deployment, there's a route that fits their systems and ultimately their timelines as well.
And that's a very useful distinction because it shows that this is more about enablement than integrations. And most teams can make progress quickly without heavy technical work or disruption. So final question then, building a business case. So Raj, if a finance leader is sitting on a 60-day DSO and losing around 16 hours a month just from resolving payment issues, how should they think about the business case for change? And also, what does success look like if they're trying to bring that DSO closer to 30 days?
Sure. Well, I think there's a few things there. I think first and foremost, cash flow impact on the business. So if your DSO is 60 days, reducing it to 30 days means obviously cash arrives a month earlier in the business, which then has a really good effect on sort of the overall cash flow of the business, and therefore less reliance on overdrafts or expensive short-term borrowing for the business. And then we've got things like operational efficiency. So if finance spends 16 hours a month fixing payment issues, that's time lost from forecasting and planning and other important strategic parts of the business that they should be focusing on. And then ultimately the ROI, payback often comes through growth and greater credit control efficiencies, increased profitability as there's less reliance on expensive lines of credit, and improvements usually show within the first couple of invoice cycles as well. So ultimately, you've already earned this money. This is all about making it as easy as possible to get it when you're supposed to.
Yeah, and Raj, I suppose when you frame it that way, this stops being a cost discussion, starts being like a growth conversation, right? So you're unlocking cash that the business has already earned, not adding new overhead. to thanks again for your insights there. Now we're almost out of time, so let me close with a few reflections. Now, what's come through very clearly today is that late payment is rarely about intent, right? It's about friction, manual steps, approval bottlenecks, disconnected systems, and outdated, obviously, payment journeys that no longer reflect how businesses actually operate. Now, the encouraging part is that this isn't a future problem to solve. Now, the tools already exist, whether that's better payment choice, pay by bank, or tighter integration with accounting platforms. And crucially, for resource-constrained teams, this can be done incrementally without major disruption or upfront costs. Now, obviously, with regulatory pressure increasing as we move throughout 2026, the incentive to modernize is only going to grow. So I just want to say a big thank you to Raj and Alex for a genuinely insightful discussion. And thank you for joining us. And I hope you leave with a clearer sense of where the invoice payment gap comes from. More importantly, how to start closing it.